we continue to analyze the tools and strategies of technical analysis. And in this video, I want to talk about one very interesting trend, an indicator that is different from the usual indicators. Apart from actually looking for short, medium, and long-term trends, it also helps in proper trade management, exits. Whoa! This is a profit and also indicates market volatility. It is about an indicator called the Bollinger channel. To add it, we go to the indicator menu, enter its name in the search, and add it with the standard settings. It looks like a classic moving average. It has a period of 20 in this case. These are usually exponentially moving averages. And if you've looked at a technical analysis strategy before, you know that it trades on the crossing of the chart of this moving average. For example, when the chart crosses a moving chart from the bottom to the top, this is a signal for an uptrade. When the chart crosses the moving charts from top to bottom, it is a signal for a down trade. But this strategy has several disadvantages at once. For one thing, it will perform very poorly in the fleet, as any technical indicator would. Secondly, when you focus only on the breakout, moving average charts, then any correction, such as this one, will be misleading. Here, according to all the rules of moving average trading, we should have closed the trade upwards, because we have a breakdown from the bottom upwards. But as you can see, the chart reversed and went down. And the Bollinger channel is a much more versatile tool in this regard and a much more effective tool. The indicator also includes two blue lines, which are equidistant from the orange moving average. When I say equidistance, it doesn't mean that at any given time, they will be traveling the same distance. The channel can narrow and widen, indicating how volatile the market is right now. If the distance between the blue channel lines is narrower, it means that there is little volatility in the market. Conversely, when the channel widens, it indicates high volatility. And it is during periods of high volatility that we need to trade on the trend, because we are not interested in small price fluctuations. Usually, when the market has low trading volume and high volatility, strong long-term trends do not appear in the market. We need exactly the periods when the chart expands, and these lines are calculated by a rather complicated form of standard deviation. But if we simplify, they show how many points the chart passes on average over a specified period of time, specified in the indicator time period settings. That is, if we have a chart that goes a short distance, then the standard deviation of the price will be low, which means that we should trade the chart inside this volatility channel, the narrow volatility channel. Conversely, when the chart goes a long distance, volatility expands, the lines get wider. And that tells us that the standard deviation of that moving average is going to be pretty high. Now let's talk about how traders usually trade on channels. Here's if we open the chart, which usually from what I see, traders use the blue lines as a kind of bought and oversold indicator. Or when the chart comes to the upper boundary, they trade down, and when the chart comes to the lower boundary, they consider the asset oversold by them and open up. And this is how traders usually trade on the bounce from the blue line, and this strategy has the right to exist. It will even perform quite well, but only in new markets. And like I said, it's a trend indicator, and it's best used for trending. And when you meet a real trend, this strategy of trading a bounce from the blue line will bring you only a loss. Because here, for example, specifically in this case, we have a touch of the top line. We have to close the trade down according to all the rules of classical trading. But as you can see, the chart just continued to rise each time towards the top line, and each time giving a negative bounce signal. Therefore, I offer you another strategy, which is much better suited specifically for finding trends, their movements in the market. It is called more E-channel breakdown. We will be looking for times when the chart exits the fleet, leaves the consolidation zone, and moves into a real trend. And the channel is very good for this, because it fixes at the very beginning of this breakdown, the very beginning of the trend. And we, unlike many trading strategies, do not miss the very beginning of the trend, but trade from the very beginning. and capture all trend movements. So we need periods when our lanes are narrow and the graph is moving. Next, we need to find the moment when the channel starts to expand. That is, when volatility in the market becomes higher. Such as in this case, we had a narrow channel at first and now it is wide. Next, we wait to see exactly which way the chart will be broken. In this case, it's broken upward. The chart has gone beyond the upper boundary of the channel, and this gives us a signal to open a trade upwards. The opposite situation, for example, is here we had a narrow channel at first, and then it started to widen. After all, there is an expansion zone, and we can see that the channel has been broken down. That is, we saw the beginning of the trend downward was broken through the lower boundary of the channel. And here, we could open a good trade, down to trade this strategy more clearly. There's an additional indicator called Bollinger Band Off, which is width, bowling, AP. This indicator in the form of a curved line shows us how wide the channel boundaries are now. When the chart shows low values, it means that the channel is narrow and volatility in the market is low. When it starts to rise, we see a period of high volatility. That is, literally, we can make deals only focusing on the IF indicator. Let's look at another example of a transaction. Here, for example, we see that we have low volatility in this area. Next, we wait for volatility to start rising and the channel to widen. As you can see, you can even visually see here that the channel has become much wider. And the next step, we look at exactly which line was broken. In this case, the lower line has been broken. So at that point, we open a trade down. As you can see, over such a fairly long stretch of the chart I'm using for the review, this strategy has performed well every time. We can also scroll further down the graph and see what happened next. What were some examples of this strategy? Again, we have a low volatility period. We have volatility starting to rise, channels are expanding, and then we look at which line has been broken. The top line has been broken. We can open a trade up here and so on. You can test this strategy on history, and you will see that it gives a pretty good performance. These are good indicators, the right deals. Therefore, I can recommend to both beginners and experienced traders a few important points about the strategy to cover before you start testing. First of all, if you use an indicator and channel width, rather than focusing on exactly which way the chart is moving. That is, if a chart grows more IF, it doesn't mean that the price chart will grow as well. The line of this indicator shows only the level of volatility. If the line is growing, it means that the volatility in the market is growing. It can be either up or down. As you can see, in this case, just down. We got a sharp price moment and it went down. And thus with this strategy, we first look for the moments in which the market appears. Is the momentum bullish or bearish? And then we look in which direction this impulse is directed and use it to make our trades. In general, the strategy is well suited for assets that don't move. For assets that are more likely to move, more often, it is the new moves. It's manager-type currency pairs, it's cryptocurrencies, and it's stock markets and stock indexes. It's worth avoiding trading commodities and bonds because they often move in flotsam. And any trend is a new indicator. Any new strategy shows pretty bad results. In fleet time frame, I recommend using 15 minutes, but if you are a beginner, you can start at 1 o'clock. Then the signal will appear less often, but their quality will be noticeably better. Conversely, if you are an experienced trader, you can go down to 5 minutes and get signals on this strategy much more often. But note that there will be a lot more market noise. Be sure to try this strategy of your trading and share your results.